All right, guys, welcome back to the channel. So I appreciate I've been a little bit quiet. I'm down to one video a week at this point in time. There are reasons for that. We can talk about it a bit later on. But I do want to talk about the UK market in this video because if someone told you that the FTSE 100 will be performing better than the S&P 500, given the craziness and all of the pressures that we're feeling right now, would you believe it? I'm not sure that I would have necessarily believed it without digging deeper into the details of why the FTSE is doing so well. So that's going to be the conversation in this video. There will be some lessons, obviously, that come to the forefront when we talk about this and we explore this topic. And this will be particularly useful for you if you have spent maybe the last 2 years and what you've been doing is essentially accumulating or building a portfolio with individual stocks. So we'll talk about that in a moment around diversification. But here's a timeline on the FTSE for you. So the FTSE 100 was founded in 1984, base level 1,000 points. Okay, so 1,000 was the base level. Now the highest we've ever seen, the FTSE, so far since its inception in 1984, is 7877.45. That was on May 22nd of 2018. Now, over the last 2 years, we've obviously had lockdowns, we've had COVID, we've had market volatility, but within that period of time, we've also seen quite a lot of market growth. And that is evidenced quite nicely in the charts when you compare the FTSE 100 to the S&P 500. This is one right here. The divergence that you're seeing between the green lines and the blue lines is essentially the fact that the S&P 500 has so much exposure to tech, and tech has been a big growth engine for the S&P 500 over the last few years, certainly, if not a little bit longer than that. Now, it's interesting when you think about the S&P 500 and the FTSE 100 because oftentimes those things are actually benchmarked together. The S&P 500 are the top 500 companies in the world, but certainly in the US because they're US based, it's the domestic US based indices. Whereas the FTSE 100 is our local 100 top performing companies, our biggest companies. And so those two things are often benchmarked, albeit they are very, very different beasts. One of the big differences that you'll notice, and I've already alluded to this, is the fact that we don't really have a lot of tech giants in the UK, included within the FTSE 100. In fact, if you want exposure to Amazon, Apple, Google, Meta, Tesla, all of these big tech companies, Microsoft, well, you have to go to the S&P 500 or the American markets to get access to that because we don't have a great crop of tech companies that have the track record of the ones that I've just mentioned there and plenty more. And this really lends itself to the reasons why, if you look at the FTSE 100 and the S&P 500, given the inflation pressures, we've seen monetary policy change this year in the first 6 months, 5 interest rate hikes here in the UK. We've seen interest rate hikes in the US as well. When you look at all of that and you look at the pressures that the markets are under, the S&P 500 is down double digits, over 20%. The UK FTSE 100 is down less than 5%, just under 5%. So when you look at it, it's quite a big disparity. But what I want to do is I want to maybe just tighten the time frame a little bit on the FTSE 100, just to provide a little bit of context, okay? So if you look at the performance of the FTSE 100, so on January 4th, 2021, just a couple of years, well, last year actually, the FTSE was at 6460. 6460. If you look at the FTSE as of the beginning of 2022, the FTSE opened at 7384. So we know that there was quite a lot of growth through 2021, regardless of the issues that we faced and the volatility that we faced. There's still quite a bit of growth. 7384 versus 6460, literally 12 months apart, is a nice bit of growth. But today, as I'm recording this, the FTSE is at 7306. So remember, January 2nd, 2022, the markets opened, the FTSE was at 7384. As of right now, as I'm recording this video, the FTSE is at 7306, which is around about 571 points off its all-time high that we saw in 2018, and about 78 points of where it was on January the 2nd this year. Very, very different to the S&P 500. And again, looking at this chart, you can actually see the difference in how it's actually performed. Now, why is that? That is going to be the biggest question. So we already know that there's a lot of tech companies in the S&P 500, and tech companies don't typically do well when you're facing higher inflation because of the way these companies are actually valued. And so if you look at the domestic market, the FTSE 100, we've got a lot of traditional companies built in, right? So when I say traditional companies, you've got a lot of banks, we've got some energy players in there, we've got Rio Tinto, we've got some really strong companies who are essentially dividend paying, who are well established, who have products and services that we need. And we haven't got too much exposure to that sexy stuff. And that is one of the reasons why we're seeing the FTSE hold up when all the other markets are pretty much down double digits. Now, what does that actually say if you're looking to invest, particularly if you've been investing over the last couple of years? And what you've been doing is essentially putting together a portfolio where you have got individual companies and your concentration has been on the US. I've always talked about the fact that diversification is really, really key when you're looking at investing. Yes, you've got to think about the fundamentals first. So why are you investing? What's your timeline? What is your strategy based on the goal that you have for why you're investing in the first place? Now, speaking to a couple of my mates who are still within, investment management, who are investment managers, so on and so forth, there is a lot of emphasis right now in the professional realm around strategic asset allocation. So asset allocation as a whole, but that breaks down into two sections. So asset allocation, if I put that literally right there, it's kind of like a pie, right? If you're using Trading 212, you might have a pie. And within your pie, you will have different category of companies, right? And it's really important to understand that when you're investing in companies on an individual basis, you need to think about where they're actually located for geographical exposure. So a lot of people may have only just invested in the US specifically. If you have, you've probably seen your stocks take a little bit of a hit quite significantly this year alone. But one of the key things about diversification is making sure you've got access to companies that are not just within, the US geographical region. You want to have a look at UK, Europe, maybe even China. And yes, emerging markets do have a few issues at this point in time. But what it does is it allows you to spread your risk across those economies, because in situations like this, the 10 or 15% that you may have had in the UK, and I'm just making this number up, by the way, guys, is going to be less volatile, would have suffered less than if you had all of your money put into the S&P 500 or the US markets as a whole. That's the real key thing about diversification, and really thinking about your asset allocation, how you're going to allocate your money within a portfolio. Now, within the professional world, there's a lot of conversations about asset allocation, strategic and tactical asset allocation, right? The ability for you to have a long-term goal where you're looking to maybe purchase a house or save for your kids' university fees. You have a mixture of companies based on what the companies do, sectors, geographical regions, so on and so forth, that you purchase to build your portfolio with the aim that it's going to make profit in the long run. But tactical really looks more at situations like this, where we are facing high inflation and you may need to make a little bit of those quick moves into safer companies that won't be as volatile. So for example, tech, we know, tends to suffer in high inflation environments. So do you go towards companies that are long-standing, a Rio Tinto, a Coca-Cola, for example, where actually those services, those products are still going to be needed, they're still paying out dividends, they can offer you a little bit of security. This week is going to be very, very interesting from an economic and investment market point of view. The Fed are meeting again this week. They are rumored to increase interest rates over in the States by 0.75%. It was supposed to be 1%. There's still a 20% chance of that happening. We've got about a third of the S&P 500 companies reporting earnings, including some of the big ones like Microsoft this week. We've got the European Central Bank also meeting on rates. And right after that, we should be hearing from the Bank of England as well around what they're going to be doing with interest rates. We do know that this is a very, very volatile situation, and we have a lot of volatility in the market right now. There's a lot of uncertainty. There's still fears about a recession, and it's interesting seeing the retail numbers out of the States. Whilst the retail numbers were 1% better than expected, it can't really tell the story, and it doesn't really tell the story that there is, I guess, a retail resilience versus what's going on. Because when you really dig down into the fact that the retail numbers were 1% better than expected, it was because things cost more, not because people actually spent more willingly. They had no choice. And so very, very interesting times right now. What I would say is that if you are invested at the moment, and please don't take this as advice, but please use it as something maybe to consider. It's really, really important that you start thinking about the diversification strategy if you haven't already. A lot of gains, and this is something that one of my colleagues said to me last week. A lot of gains in the portfolio are actually made via your asset allocation. Just let that ruminate, and I'm going to leave you on that note because it makes 100% sense. Did you get it? Let me know in the comments. See you later.